Take a piece of paper currency out of your wallet and look closely at the text. You'll see a specific promise signed by a central bank governor. That physical note is inherently worthless. Its purchasing power exists entirely because you trust the government institution that printed it. Thousands of years ago, commerce relied on barter. You traded a kilo of wheat for a glass of milk. The system worked locally, but failed at scale because there was no standardized way to measure value across different goods. The historical solution was the gold standard. Every paper note in circulation was directly backed by a physical asset. Money was essentially a receipt, proving you owned a specific fraction of physical gold stored in a government vault. But tying currency to physical gold restricted economic growth. To fund massive projects or stimulate an economy, governments needed the ability to print money on demand, so they abandoned the gold standard entirely, creating fiat currency. This shift placed absolute control over the global financial ledger into the hands of centralized authorities. Your bank account balance is now completely dictated by an institution's internal accounting system. We've seen the extreme consequences of this power in real time. During demonetization in India, the government instantly decreed that 500 and 1,000 rupee notes were no longer legal tender. The cash in millions of pockets lost its value overnight. Our current financial reality forces every citizen to rely entirely on a centralized point of failure. It is a system built on institutional trust, leaving a massive opening for a purely mathematical, trustless alternative. In October 2008, an unknown author named Satoshi Nakamoto published a short research paper. It outlined the architecture for a completely transparent digital currency that no single entity could own or manipulate. This diagram illustrates Nakamoto's core innovation. Instead of relying on a single bank's private master ledger to track account balances, this system distributes the exact same master record across thousands of independent computers worldwide. To send money, you only need a public digital address and a private cryptographic key, essentially a highly secure password. You can transfer value directly to anyone else on this network without asking a bank for permission. The moment that transaction hits the network, millions of computers instantly cross-reference their ledgers to verify the funds exist. Once confirmed, they all update their records simultaneously to lock in the transfer and prevent any double spending. By completely stripping away the central authority, this architecture guarantees your money is finally controlled exclusively by you. But if there is no government guaranteeing its value and no physical vault of gold backing it up, why is a string of digital code trading for tens of thousands of dollars? This chart displays the primary economic driver, absolute scarcity. While central banks continually print fiat currency, driving its supply endlessly upward, Bitcoin's underlying code enforces a strict mathematical ceiling. There will only ever be 21 million Bitcoins in existence. In its infancy, this scarcity meant very little. On May 22, 2010, a programmer famously traded a massive amount of Bitcoin just to get 2 Papa John's pizzas delivered. He paid exactly 10,000 Bitcoins for that meal. At recent market peaks, those same 10,000 coins held a valuation exceeding $300 million. Over the last decade, as millions of people recognized the utility of a trustless, borderless network, global demand skyrocketed. All of those new buyers are competing for a resource pool that simply cannot expand. Bitcoin's valuation isn't a magical phenomenon. It is the raw economic output of massive, growing demand colliding with an unyielding mathematical wall. However, precisely because it is an emerging digital asset traded on a global 24/7 market, Bitcoin is incredibly volatile. Prices can and do experience aggressive double-digit swings in a matter of days. This asset requires strict discipline. Attempting to time the market to get rich quickly or pouring your life savings into short-term trades is a fast track to financial ruin. Your secure financial baseline must come first. The overwhelming majority of your investment capital should remain in stable, proven vehicles like index funds, mutual funds, and traditional equities. Looking at a standard portfolio breakdown, risk management experts generally suggest capping your digital asset exposure. Limit your Bitcoin investments to no more than 5 to 10% of your available excess capital. Rather than buying a large lump sum and watching the price chart anxiously, consider a systematic investment plan. Purchasing a small, fixed amount every month smooths out your average entry price and neutralizes the stress of market volatility. To execute this safely, you have to use a legally compliant, locally regulated exchange. Completing the standard KYC verification ensures you have a secure, legal bridge between your traditional bank account and the blockchain. And remember, the protocol is highly divisible. You don't need the massive capital required to purchase a full coin. By accumulating small fractions over time, anyone can secure their own piece of a decentralized financial network.